Most traders believe they are battling volatility, reacting to news, or competing against algorithms too fast to see. This belief is comforting because it transforms failure into something external and impersonal. The truth, however, is far more unsettling. Richard Wyckoff observed over a century ago that markets are not chaotic arenas of random chance, but carefully orchestrated campaigns conducted by what he termed the Composite Man, a singular intelligence representing the collective intent of institutional operators who control price, volume, and sentiment with methodical precision. The retail trader enters this arena convinced of autonomy, armed with indicators and chart patterns, believing that discipline and analysis will yield profit. What they fail to recognize is that every decision they make has been anticipated, every emotional impulse has been mapped, and every technical signal they trust has been engineered. The Composite Man does not trade against retail. He trades through them, using their fear as fuel for accumulation and their greed as the exit liquidity for distribution. This is not conspiracy but mechanism. Wyckoff taught that markets are human behavior rendered visible, and human behavior is predictable under pressure. The Composite Man understands this with surgical clarity. He constructs traps not through brute force, but through patience, using time, silence, and carefully timed volatility to exhaust, deceive, and transfer wealth from the undisciplined to the prepared. The retail trader fights ghosts because they cannot see the predator orchestrating the shadows. Once you learn to recognize the architecture of these traps, the market ceases to be a mystery and becomes a readable script, a script written by the Composite Man every single month. Wyckoff identified three fundamental laws governing market behavior, and the most critical among them is the law of cause and effect. This principle states that every significant price movement must be preceded by a period of preparation proportional to its magnitude. In practical terms, accumulation creates the cause for markup, and distribution creates the cause for markdown. The Composite Man cannot simply force price in a direction without first building position, and this construction phase occurs within trading ranges that retail traders dismiss as lifeless noise. These periods of consolidation are not accidents of market indecision, but deliberate campaigns of absorption. While price oscillates within a narrow band and volume contracts, the Composite Man is methodically buying from impatient sellers or distributing into the hands of hopeful buyers. Retail traders, conditioned to seek action and immediate gratification, abandon these zones in search of momentum elsewhere. They interpret silence as absence, failing to understand that the most dangerous market condition is not volatility, but the quiet before calculated violence. The architecture of every trap begins here, in this silence. The Composite Man uses the range to accomplish two objectives. He transfers position without moving price significantly, and he conditions retail psychology to expect continuation of the range, making the eventual breakout appear genuine. The longer the cause, the greater the effect. A month-long accumulation range will produce a markup far larger than a week-long consolidation. This is not theory, but observable law, repeated across every market and time frame with mechanical reliability. Understanding this law transforms how a trader perceives price action. Boring markets become theaters of hidden intent. Consolidation becomes the most critical phase to study, not the explosive moves that follow. The traps are not set during the breakout. They are constructed during the silence that precedes it. The Composite Man deploys three primary mechanical traps with ruthless frequency, each designed to exploit predictable retail behavior at critical technical levels. The spring is perhaps the most elegant. Price breaks sharply below established support, triggering stop-loss orders and igniting panic selling among those who believed the floor would hold. Retail interprets this violation as confirmation of weakness, and either exits in fear or initiates short positions. What they fail to recognize is that this sudden drop is not the beginning of decline, but the final shakeout before accumulation completes. The Composite Man absorbs their selling with precision, and within hours or days, price reverses violently upward, leaving retail stopped out at the worst possible price while smart money holds newly acquired position. The upthrust operates as the inverse mechanism during distribution phases. Price surges above resistance with conviction, often accompanied by increasing volume that appears to validate the breakout. Retail traders, conditioned to chase momentum and fear missing opportunity, enter long positions as confirmation candles print. The Composite Man uses this enthusiasm as exit liquidity, distributing his accumulated position into their buy orders. The breakout fails almost immediately, and price collapses back below resistance, trapping late entries in losing positions while institutions exit at optimal prices. The false breakout is more insidious because it unfolds slowly, appearing sustainable rather than impulsive. Price crawls beyond a key level over multiple sessions, building retail confidence through gradual confirmation. News narratives often align to justify the move, creating psychological reinforcement. Position sizes increase as fear of missing out intensifies. Only after retail commitment reaches saturation does the Composite Man reverse the move, collapsing the breakout and converting what seemed like careful entry into catastrophic loss. Each trap follows identical anatomy: deception, emotional bait, mechanical reversal. Not all traps execute with violent precision. Some operate through psychological attrition, dismantling trader conviction through relentless tedium rather than shock. The grinding range represents the Composite Man's patient assault on discipline and capital. Price becomes imprisoned within a suffocating horizontal channel, oscillating between support and resistance with micro-volatility that promises breakout, but delivers only false starts. Every attempted entry is invalidated by whipsaw reversals. Every stop-loss placement becomes a target for brief penetrations that trigger exits before immediate reversal. Traders bleed not through catastrophic loss, but through accumulated small defeats, spread across weeks of opportunity cost and mounting frustration. The Composite Man requires no dramatic action here. Time itself becomes the weapon, and retail capitulation arrives not through panic, but through exhausted abandonment of position and attention. The hope rally deploys after accumulation completes, when the Composite Man initiates markup with calculated restraint. The advance is gradual, sustainable in appearance, punctuated by shallow corrections that mimic healthy consolidation. Retail traders, burned by false breakouts and wary of traps, enter cautiously at first. As the rally persists and confirms through higher lows, confidence builds and position sizes increase. The cautious become convinced, the skeptical become believers, and the fearful transform into optimists. This is precisely the psychological shift the Composite Man requires for distribution. Just as retail commitment reaches maximum saturation and additional capital flows into buying the dip, the character of price action shifts. The rally stalls, corrections deepen slightly, and what appeared to be pullbacks become the early stages of markdown. Retail interprets these declines as opportunities, adding to losing positions while the Composite Man distributes into their renewed hope, converting their optimism into his exit liquidity with surgical efficiency. The most sophisticated traps exploit not merely technical patterns, but the deeper architecture of market structure and collective psychology. The liquidity sweep operates on the principle that stop-loss orders cluster predictably below key swing lows and above swing highs, creating concentrated pools of available liquidity. The Composite Man drives price temporarily into these zones, not to establish directional momentum, but to harvest the fuel necessary for the opposite move. Retail traders observe price breaking a significant low and interpret this as bearish confirmation, either exiting long positions or initiating shorts. Institutions recognize this sweep as the acquisition phase before reversal, absorbing the liquidity generated by triggered stops and using it to propel price aggressively in the intended direction. What retail perceives as momentum is actually the Composite Man gathering ammunition for the countermove. The narrative hijack represents the convergence of technical manipulation and psychological warfare. The Composite Man coordinates price action with external events, earnings releases, geopolitical developments, or economic data, timing distribution to coincide with bullish narratives, or accumulation to align with fearful headlines. Retail traders believe they are reacting to information, making rational decisions based on fundamental catalysts. They fail to recognize that the narrative serves merely as camouflage for technical positioning already in motion. News does not create the move. It provides the emotional justification that disguises institutional intent as organic market response. The trader who sells into fear-driven headlines is providing accumulation liquidity. The trader who buys into optimistic narratives is absorbing distribution. These traps succeed because they exploit the human need for causality, the comfort of explaining price movement through story, rather than recognizing the engineered transfer of position occurring beneath the surface noise that captivates attention and hijacks judgment. Recognition of these 7 traps is necessary but insufficient for transformation. Knowledge without application remains theoretical comfort that dissolves under pressure when capital is at risk, and emotion floods judgment. The counter-strategy requires a philosophical reorientation. The trader must cease trading price and begin trading the composite man's intent. This shift demands patience that feels unnatural, discipline that contradicts instinct, and humility that accepts the market's truth over personal prediction. Wyckoff taught that the tape is always right, and arguing with price is financial suicide. The trader's singular responsibility is alignment with institutional positioning, not anticipation based on hope or narrative. Practical application begins with inversion of retail impulse. When price springs below support, the disciplined trader recognizes potential accumulation rather than breakdown. When ranges grind endlessly, attention intensifies rather than abandons, understanding that cause is building for significant effect. When liquidity sweeps, trigger stops. The prepared observer waits for reversal confirmation rather than chasing apparent momentum. When narratives align perfectly with price movement, skepticism replaces conviction, recognizing potential distribution, camouflaged as organic response. Every trap becomes a signal when viewed through the lens of institutional intent rather than retail reaction. This approach transforms failure from financial loss into educational investment. Each trap encountered and recognized becomes a lesson in reading the invisible opponent's campaign. Mastery is not achieved through complex indicators or algorithmic precision, but through simplicity. Observe the cause. Wait for the trap to exhaust. Enter when the composite man's position is revealed through price behavior that contradicts retail expectation. Discipline replaces emotion. Logic replaces narrative. Patience replaces urgency. The trader who internalizes these principles ceases to be prey and becomes student of the predator, learning to move when institutions move, rest when they accumulate, and exit when distribution begins its silent work.